It's Investing 101. Caitlin, what is investing?
Look, there's a lot of meanings of investing, but in the finance world, it essentially means putting your money to work in something that you expect is going to generate a return or a profit or an income stream, or even better, both.
So we're used to just working for money, but also our money can work as well.
Exactly. If you're smart with it, your money can do a lot of work for you. So in the future, you don't have to work as hard.
Wow, I'm imagining in my mind a little Kate Shepherd off to work with a little Emma Hillary. Liam as well, what would you say is investing? How would you define it?
Yeah, I'd define investing as putting some money into something like a good or an asset. It could be property, it could be shares or bonds. It could even be something rare that a lot of people want, but there's not many of those things out there. I'm sure we'll get into it later on. But really what you're hoping is that the thing that you buy will either provide you with an income, or it will increase in value over the long term, or it will do both.
Okay, let's talk about some terminology, because there's a lot of fancy words. Let me list some of them for you. Stocks, shares, bonds, liquidity, equity. What do all these words mean? Do I need to know what they mean?
You should know what they mean, just for your Kiwi saver, and Liam can go into that. But stocks and shares are essentially the same thing. So you own a share of a company, you own a slice of the ownership in that company. So the company does well, you do well. You know, company's making a profit, you do well, the share price goes up. Company's not doing well, your share price goes down. You're not doing so well with your investment. So shares are probably the easiest to understand in terms of the investment terminology. Bonds are essentially loans to government or corporate. So you're essentially loaning money to someone, and they agree to pay you an interest rate over the term, and then at the end you get your money back.
Is that why they call the underwear bonds, because it's the more stable?
I mean, I haven't tried them out myself, but
They last a long time.
if they're better, then
I think I'm wearing some right now. Let's move on to liquidity.
liquidity is, and this is a good one when we talk about the property market. Now, your property isn't very liquid, and what we mean is how quickly can you turn your investment into money without affecting the value of it. So shares and bonds are considered a lot more liquid than property. So your physical assets take longer to go and sell. You know, you have a house, it's a huge investment, whereas you want to sell one share or one bond, it's a lot more liquid. You can get that cash a lot quicker.
What about dividends? What's that?
So we spoke about bonds, and they make interest payments to you. So those are contractual. So, you know, you're guaranteed to get those interest payments twice a year. And if something happens that the company defaults, you rank a lot higher than someone who owns the shares. Some companies, the way that they return value to shareholders, and it's usually your more stable ones that, you know, they're not going to skyrocket with the share price, but the way that they're going to entice investors to invest in them is by paying them a dividend. So it's essentially like an interest payment, but they're not 100% obliged to pay it. If the company's not doing well, you mightn't get it. If the company is doing well, this is one way that you might benefit from the company's profits.